Hi, this is Jim Dolly, the founder of the White Coat Investor, and today we're going to talk about the 7 principles of bond investing. Principle 1 is that a bond is a loan. A loan is just like borrowing money from anybody else, right? You can borrow it from a national government, a state government, a city government, a municipal government, even a company or a corporation. But the principle of the bond is the amount that's borrowed. The maturity of the bond is the due date, when you have to pay the money back by. And the coupon of the bond is the interest that's paid on it. And so you can use these investments as part of your portfolio. They're considered a fixed income investment to basically buy loans. For example, a loan from Apple, or a loan from GM, or a loan from the US government, or a loan from the Philippines government. Those are all considered bonds. Principle number 2, there is an inverse relationship between bond value and interest rates. As interest rates go up, the value of your bond goes down. And the reason why is because somebody can go out and buy a new bond with the new higher interest rate, and thus your bond's value, the principal of the bond, has to be adjusted such that the yields of the two bonds are the same. So as the interest rates go down, the value of the bond goes up. As the interest rates go up, the value of the bond goes down. It's really important to understand that. Principle number 3, the higher the yield, the more risk there is with the bond. Even if you can't see exactly what the cause of the risk is, be assured if the yield of the bond is higher, there is more risk. It might be because the time to maturity of the bond is longer. It might be because the issuer of the bond, the person borrowing the money, is not as creditworthy as somebody else. But there's always a reason for the yield to be higher, and that's usually a pretty good measure of risk for the bond. Principle number 4, the yield is not the return. With a bond, the yield is how much that bond is likely to return between now and at maturity. But that assumes that you actually get your principal back. If you don't get your principal back, your return will be much less than the yield on the bond. This is a really important thing to understand, particularly with lower quality bonds, often called junk bonds or high yield bonds. A certain percentage of them are going to default. So even if you have a portfolio of 100 of them with a yield of 8%, you might find that your total return, which is what really matters, is only 5% because a number of the bonds defaulted and you didn't get all your principal back from them. Principle number 5 is that the best estimate of the future return of a high quality bond is its yield. A bond fund or a bond that's yielding 3%, your expected return on that investment is about 3%. Now, depending on what interest rates do between now and some period of time in the future, you may get a return of more or less than 3%, but your expected return is 3% because that yield to maturity is a good estimate of what return to expect from the bond. That means these days when bonds are paying 2%, 3%, 4%, that's what the return on your investment should be expected to be over the long term, assuming interest rates stay stable. Principle number 6 is that it is critical to keep your costs low when investing in bonds. Bond yields are not particularly high these days, and so if your bond is only yielding 2.5% and you're paying 1% of that to a manager or to a financial advisor, you're losing 40% of your return from that bond. And so keeping your costs low is even more critical in bond investing than it is in stock investing. And principle number 7 is that duration helps you estimate how sensitive your bond or your bond fund is to interest rate changes. For example, a bond fund with a duration of 5 years means that if interest rates go up by 1%, you're going to lose approximately 5% of the value of your money invested in that fund. If interest rates went up 2%, you would lose 10% of the value of the money you have invested in that fund. Likewise, if interest rates drop by 1% and the duration of the fund is 5 years, then you would gain 5%. You would have an additional capital gain on that fund of 5% for each 1% that the interest rates drop. So those are the 7 principles of bond investing. Sometimes you have to run through them a couple of times to get them, but once you understand them, you'll find that bond investing is actually relatively straightforward and relatively simple, and certainly is something worth including in a diversified portfolio.